Cool. So I'm going to be talking today about revenue-based financing and how that changes the incentive mechanisms and the possibilities of what we can fund within the crypto ecosystem. So first, a little bit about me. I'm a software developer. I used to do Web 2 web apps, and then I moved into crypto Web 3, do kind of everything from smart contracts to subgraphs to token economics. And then I also have a background in design, doing design thinking, service design, systems design, and that's also kind of how I got into crypto. Was very much interested in how can we take all these different, very complex systems and make it so that humans can coordinate effectively within them. And so that's why I started DappCon, was I saw this gap in the market where a lot of DAOs can't get the finance they need to do their day-to-day operations, and they're kind of forced to either sell tokens or do liquidity mining or just generally do these equity-based things, which might not be in their best interest because they don't have other options. And so we are focusing on revenue-based financing as this alternative financing option for DAOs to kind of help them better execute on their missions. So first, what is revenue-based financing? Just show of hands, has anyone heard of PIPE before in the fintech space? Okay. Or income share agreements that kind of boot camps do with their software developers? No? Okay, a little bit. So basically what revenue-based financing is it's a loan, like you're typically used to, but they secure the loan with your future income. And so instead of putting up some type of assets as collateral like you would with a house and a mortgage, you say you will earn 15% of all the money that I make in order to repay back this loan that we're doing. So it's very popular with SaaS companies that have these kind of subscription-based models, but then also kind of income share agreements like they do with software developers and personal loans. So before we go into kind of why revenue-based financing is the solution that we think is best for this kind of financing, I kind of want to go into how we ended up at revenue-based financing in the first place. And so the kind of goal that I was getting at with DappCon was I was working at this DAO called Index Co-op, and they were spending millions of dollars a month on liquidity mining and contributor incentives, and kind of, you guys know the deal. And it was kind of really hurting the token price, and it was very inefficient to organize all these programs. And then it was also just not efficient from a financial perspective of how much they were spending versus how much they were actually earning from these products. And so I kind of set out to figure out how they could do capital efficient borrowing, so they weren't putting up a massive amount of tokens that they would probably have to sell their tokens to get in the first place, while also making it fully anonymous and fully trustless. So the anonymous aspect is no KYC, so that they could still do it as the DAO itself. They didn't have to do some type of legal wrapper where some kind of foundation or something was taking on the risk, quote unquote, for the DAO. I wanted to be fully crypto native, and then also trustless, where you didn't have to actually trust the DAO, and it was entirely kind of like what you do with Aave, where you know that you can be repaid, even though it is capital efficient and they're not putting up the capital up front. So kind of balancing these three constraints, where it's capital efficient or under collateralized, completely anonymous, and completely trustless, was actually a pretty difficult problem to solve because they're all kind of competing. And currently people do kind of reputation-based lending, where you're in some kind of on-chain credit score, but that I would not consider anonymous or trustless. You're trusting that someone's going to repay based on some kind of personal history, even if that history is associated with an anonymous smart contract wallet or something. So another way to frame this is how can DAOs effectively and sustainably finance their operations while remaining autonomous and crypto native. So allowing the DAO to remain a DAO and not create all these other legal structures and other kind of power structures through off-chain entities that are in charge of executing on their behalf, but making it so that the DAO is what is in the smart contracts and the DAO can control those smart contracts directly, which means you're not kind of delegating decision-making power to other people off-chain, while also allowing the DAO to do what it wants to do better by having these financing options. And so what we're doing at DappCon is doing economic and technical research and development into coordination mechanisms and alternative financing to better enable DAOs to finance their operations and give autonomy to them and allow them to build things better without these perverse incentives from equity and VCs and some other things. And specifically with revenue-based financing and debt financing, it's a lot better for public goods infrastructure because you don't necessarily want someone to own, the roads or the internet. You want that to be completely free and public for everyone to use equally. And so without equity-based financing, then you have this alternative where public goods can now get the financing that they need, while also repaying investors, while also not having the protocol be captured and become a private good. It can remain as public goods. And through all this, we've come up with crypto native credit, which is essentially allowing DAOs and on-chain entities to take out loans and lines of credits and any type of debt financing completely on-chain, which is in contrast to things like Maple or Clearpool or Goldfinch, which, while they do capital formation and have their pools on-chain, all of the lending infrastructure is off-chain. So you don't necessarily know where the money's going to or what they're spending the money on. You don't know what the actual business operations and the financial accounting of the companies that you're lending to necessarily are. Like we saw with FTX, it's a great example. They technically had these assets, but they were double promising them across different lenders, and they obviously didn't know what their books really were. And so crypto native credit kind of addresses a lot of these issues that we saw with the collapse of the bull market a few months ago, where a lot of the issues were caused by lack of lending infrastructure to more corporate entities. And currently, we're at the Funding the Commons residency here in Berlin, where we're exploring a lot of these ideas and partnering with a lot of other teams to explore how we can better finance public goods and get them the money that they need to build, like fully open source and trustless software. And yeah, so this is kind of like the landscape that we're looking at that we mentioned with the kind of difficulties of doing anonymous, trustless, and capital efficient. And so these are kind of like the different ways that people kind of raise money. So at the top, there's technology, where you're saying, we want to build cool things together. And then community on the side, where it's like, I want to build cool things with cool people. And profitability is, I want to build cool things that just make me money. And then you have these three different kind of financing options that lean towards like two of those sides. There are like ways that grants or VCs can kind of be more inside the triangle, but this is just for explanatory purposes. And so the main two that we'll talk about are grants, where you're focused on technology and community, and not so much about profitability, and VCs, where you're looking at technology and how it can be profitable towards you. And we'll look at how that kind of dichotomy plays out and where revenue-based financing fits in. So just looking at VCs, the pros are that it's usually easy money to get because there are aligned incentives between the founder and the funders, where the people that are giving you money are directly benefiting from whatever you're getting, and you're also benefiting from the same thing because you have this equity structure, and everyone's on the cap table. It's really good for getting clout and like social signaling, because now you can say that you raised from these investors, and they also give you support from services like hiring to security audits to introductions, business development. You guys are probably familiar. But the cons are that it's generally adverse to community, and so you're going to have to profit off of someone and return the VC's money somehow, and usually that comes from your users. And so it kind of creates this dynamic where you're getting money from these people, but you have to take it from this other group. But the group that you're taking money from are usually the people that you want to be the most aligned with because they're actually using your product. And then you have this kind of like VC obligation, where a lot of founders like feel the need to wake up every day and like provide shareholder value, which is generally not what anyone wakes up and wants to do with their life. But people feel obligated to do it because they've now taken this money, and they have a literal like legal obligation. And then the con is that you just have to go through the fundraising process, like always, which whether it's VCs or grants or revenue-based financing, you always have to do. And then the issue with this VC model is that they all have the same operating principles, where they are trying to get like 100x growth, and that means they have to invest in specific things. And everyone kind of treats everything like a software startup, where they expect very low cost of acquisition and that you can scale super fast. And that if you just pump enough money in, then you'll take over the market, and then you'll have a monopoly, and then you can like exit to someone. But that only works with specific models and specific business models and financial and operational models. And so when you pigeonhole the financing of these projects, you also pigeonhole like the actual things that can be built. And so this is also John from Cabin DAO, and he has a bunch of great tweets I recommend following. And this kind of like leads to the theory of the greater fool, where everyone knows what everyone else's investment strategy is, and they just try to get in early and then try to exit from these later groups in their financing rounds. So Aptos, for example, I don't know, has anyone ever used Aptos before? No one? No? Okay, well, it's $1 billion project, yeah, and no one's using it. So like, why is it worth $1 billion? And that's generally because the VCs know that if they get in early, then eventually someone else, and if they like meme it enough and they make it popular enough, they can exit to someone, whether that's other VCs or to retail liquidity on centralized exchanges or what have you. And this isn't just a Web3 problem, it's also a Web2 problem with WeWork. No one knows why WeWork was worth whatever, $40, $50 billion. But SoftBank is the one that kind of like took the hit on that, because all the other investors kind of got to exit through the SoftBank's Vision Fund investing in them. And so these are just some examples of the perverse incentives that only having VC funding creates within the crypto ecosystem and generally startups. So now looking at grants programs, in contrast to VCs, we're going to skip Ponzi's because they're just obviously bad. But grants, like the pros is that it's free money. You can just get the money, you can build whatever you want to. Sometimes people don't build it. That's one of the cons, is that there's no real accountability with grants programs, except that maybe you won't get grants in the future, but at that point you've already gotten the money, so what's the point? And then usually it really aligns the community with the values that they're trying to create. So with VCs, where it's all driven by profit, with grants programs, they're very often funding things that both VCs wouldn't fund, but also that the community just inherently wants, regardless of whether or not they think it's going to make them money in the future. So let's take like Rave by Aave, where they're funding these events that they just enjoy, and yeah, community tooling, all that kind of thing. And also this goes to public goods funding, where a lot of projects just want things to exist within the ecosystem, and they don't care whether or not they make a profit off of this specific thing, because they know it's going to benefit the whole and grow the whole pie, which VCs also generally aren't trying to do. If they are investing in public goods, it's usually in some way where they're trying to capture a market and doing a fast follow fork, or something where they're essentially it's like a public goods, but they're really doing it so that they can capture a market and then still earn fees in some way and not give it away totally for free. And the other pro of grants is that it expands your ecosystem, where now you have more people building on top of it, and they're more collaborative because you've given them the free money, and then they're also probably part of the community, and so you're growing the total base of your community and who's providing value, versus generally with VCs, you become this competitive standpoint where you see people that are your competitors and you want to beat them, but with grants it's more collaborative. And the main con with grants is that they're very bureaucratic from both the funders and the grantee side, where you have to put in a ton of time to actually apply for grants and do the politicking to get it approved, figure out what they actually want, like the impact metrics that they're looking for to get from the grant. Is it developers, or is it users, or whatever? And then it's also very bureaucratic from the grantor side, where they have to go through all these applications now, and they have to spend a ton of time and a ton of resources just to give away free money again, because it's free money and they know that there's no incentive alignment. So they have to do a really good job of curating who they actually give the money to make sure that it's valuable. But that's also kind of a failure in coordination, because there is no inherent coordination within the grants model itself. And so, yeah, just the meme, like saving the world is always Sisyphean, where it's always more and more work to do good things. So even though you're doing grants and it seems like it's a great thing for everyone, where you're giving away money to community and they're just going to build cool stuff for you, it does add in a ton of work, where now you have to figure out who are actually good actors in your community, and what exact value are they providing, and are people outside of your community going to provide more value, and is there a good or bad thing with giving funding to outside community members if they're not, if they're going to provide more value versus your actual community members. And it just adds in a lot of work with the grants process, where you have to go through this whole thing of evaluation. And a great example of this is Moloch DAO, where it was intended to be a coordination mechanism itself to fund public goods, but the main issue was that they collected all this money, and like millions of dollars, and then there was no incentive to actually give it away. No one wanted to put in the work to sit there and evaluate all these proposals, and how much money should they get, and who's actually building them, and are these proposals aligned with the actual goal of Moloch DAO? And so what you actually ended up with was, ironically, a coordination failure, where no one actually wanted to give away all the money that they had collected. Of course, they did give away some things, like Tornado Cash, but a lot of the money is still just sitting there. And so this is kind of an example of the failures of the grants model, where it does seem like it's perfect in every way, but there's kind of these hidden problems. And so then that's where revenue-based debt financing comes in, where we're kind of trying to figure out this Goldilocks approach, where it's not completely about profitability, not completely about community or technology, but somewhere in the middle, where it might not be perfect for every use case, but at least it's providing a new option in the ecosystem. And so the benefits of revenue-based financing are that it's anonymous and founder-friendly. So basically how it works is, because you have this provable revenue stream that's on-chain through smart contracts, you no longer have to trust the individual. You can just look at on-chain data, and then because it's going through a smart contract, you know that that's going to be programmed to a specific thing. So once you've staked that smart contract and you're controlling that revenue stream, you don't really care who the person is, so long as that revenue stream keeps going, which at that point is generally out of their hands, assuming the product still keeps working. For lenders, it's also great because it's non-degen borrowing. The main thing for money markets at the moment, like Aave and Compound, is that it's either people that are getting leverage on their existing assets and trying to get more and more leverage, essentially, to buy more volatile tokens and then recollateralizing those to buy more, or they're using them as they actually want to be liquidated, because it's more capital efficient to get liquidated through this thing versus actually selling the tokens firsthand. And so revenue-based financing has these non-degenerate borrowing use cases, where you're using them to finance your business, pay contributors, pay for security audits, improve your product, things like that. And then with revenue-based financing, because the lenders only get paid when you make money and you're earning revenue from fees and whatnot, that now creates a symbiotic relationship where the lenders want to benefit your business, whether that's giving you product feedback, giving you clients, giving you just general support and help, because they only get repaid when you earn fees. There's no kind of like liquidation process based on assets, or there's nothing to really collateralize except unless they improve. So it creates this really nice incentive mechanism where the lenders are working in your benefit, even after they've already lent you the money. And then lending gives you uncorrelated returns to the crypto market. So instead of being exposed to volatile asset prices, you can still stay within the crypto ecosystem, but then earn a real yield from these lending operations, which are to generally better DAOs that have sustainable operations and profit models. And you don't have to be exposed to the token price while still benefiting from their success. And then it also just gives you operational liquidity versus VCs and grants, where it's very ad hoc and you don't necessarily know how much money you're going to get or when. With the line of credit and revenue-based financing, you know that you can sustainably and reliably get the money that you need to do your day-to-day operations. And then the cons of revenue-based financing are mainly that you need to already be successful to some extent. You need to have product market fit. So where grants and VCs are very useful is that you don't necessarily need to have success yet in order to get their money. And then that's good because you can then prove your success and do higher rounds or get more money later on. But then they have all the issues that we just discussed. And with revenue-based financing, you get all these benefits. But the other side is that you need to already have some success metrics that you can show to people. And then the cons versus grants is that you also have a debt obligation now that you have to repay. Same with like the kind of the VC obligation, except I feel like it's less personal. Like when you have debt, it just feels like you have to pay the thing, versus VCs, it feels like you have this personal obligation because you're the founder. And then revenue-based financing takes a lot more accounting work because you have to prove your finances and that you are profitable and that you're a business that should be lent to. And then it also takes more work from the actual financial reporting of accounting for that debt and the interest that you're paying and all those things to your existing investors. And then you still have to do the whole fundraising process of figuring out who's going to lend you money and go through that whole thing. So examples of some revenue-based financing that we've done so far. So we partnered with Metacartel to help them finance their events organization that they're running. So MCon, that's in Denver, MetaCamp, that's in Costa Rica, MetaFest, that was just last month in Croatia. They were all financed through a line of credit that they used on DappDAO, and they repaid their loans from the ticket sales and sponsorship sales that they had. And so this is really great for event organizers because a lot of times the personal event organizers are putting up their credit cards or their own obligations because they don't have the money up front from sponsors. And so the line of credit is very useful because it allows them to have the financing that they need to put down money on the venue or pay for vendors and things like that up front and kind of secure their event. And then they can more easily go to sponsors and speakers and kind of organize the rest of it. And so we found a very good model with community-backed credit and letting DAO's members lend to the DAO itself, and then they also get these kind of like mutual beneficial rewards where because I've lent to the DAO, I'm now this kind of more premium member because I'm also like have some risk in the game of the success of the DAO, and I can get special perks because of that, or just show that I'm like this extra supporter versus other people. And then we're looking at how lending and revenue-based financing can fit into the grant stack with Gitcoin and funding the Commons and all these other public goods organizations. So kind of right now, the problem with Gitcoin is that you can get grants money, but eventually they cut you off after a certain amount. And then that means that the only way that you can get financing is then just going to VCs, which has this very perverse incentive where the community is putting in all the work and taking all the risks to make your product usable and actually testing it, and also giving you the grant money to sustain yourself. But then you just turn around and you go to VCs, and VCs get all the upside because there's no way for the community to do that. And so doing this whole, changing like the model from grants to lending, and then the funders can then re-grant based off of the interest that they earn from loans. And then the founders can also then just exit to community because they don't have any equity obligations. And so they can actually give away the public goods or whatever that they're making back to the community after it's been built. And so this is all to say that revenue-based financing is regenerative financing, both from like a human perspective of the relationships that it creates, and then also from the financial model and how it fits into the DeFi stack and how we fund protocols. It's really looking at how can we create more sustainable relationships and financing models and business models and everything like that, where we're doing more slow growth and long growth and not just doing like 0 to 100 and trying to like exit as soon as we can. And this is generally just how we're looking at the solutions that we're creating. We want to do DeFi primitives, so we've invented this spigot contract that I'll get into, where we're focused on ungovernance. and revenue as a first-class citizen. So we're not looking at assets at all. We're looking at purely at who is paying you fees from a user perspective, and not taking out loans against some volatile crypto, and making everything as trustless and automated as possible and anti-fragile. I'll skip ahead because I'm a little bit out of time. So this is the Spigot contract that we use. It's a paraphrase of it. But basically, this allows us to actually do the revenue-based financing on-chain fully trustlessly. And we do that by allowing you to stake a smart contract to the Spigot, which then controls the whole cash flow for you. And so you can set a split between how much you get and how much your lender gets. And then either of you can claim the revenue, and that automatically goes to repaying your debt. And this is what makes it trustless, is because it's all smart contract based. And we know that the fees are flowing from your smart contract, so we don't need to trust you as an individual to repay your loan. We know that the smart contract will do it for us. And then this is just kind of like a systems overview of how all of our contracts work together. So you have your smart contracts, you stake them into our Spigot, and then the Spigot repays our line of credit, which the lender and the borrower are interacting between. Cool. Question time? Q&A? Yeah.
Thank you so much, Kiba. Who has questions after his talk?
Hi, thank you for your presentation. So I have a couple of questions. The first one is about, I've seen that you brought some use cases of native Web3 companies that get a line of credit by you, and are you planning to implement any sort of onboarding some companies which are not Web3 native, or that might not have part of all of the revenues on the chain, so that basically you won't be able to see them? And the second question is about regulatory. So what are you planning? Because for a regulator, this can be seen like a bank, right?
Yeah.
Thanks.
So with the first question, like off-chain entities, we have been talking to some off-chain entities because they actually find it useful that we're doing this everything on-chain. So we've talked to some kind of like taxi companies in Pakistan, to some diamond sellers in New York, like a lot of people that are unbanked essentially, that still find value in this model because they don't have access to normal financial services, essentially. And it's important to note that our line of credit contract is modular, so you can do fully unsecured loans if you wanted to, or you can do revenue-based, or you could also do asset-based, theoretically. So it's very mix and match, and you can define the terms that you want to borrow or lend against. And then in terms of regulatory stuff, so we are not actually doing the lending at DappCon, we just build the infrastructure, and we have a credit marketplace, so anyone can propose lending terms to you. So you define what you want, like I want to borrow for 60 days or 90 days or whatever, and then other people will offer you the amounts and the interest rates that they're willing to give you.
Okay, so you're like offering a peer-to-peer marketplace rather than the actual financing.
Yeah,
okay.
We're just the infrastructure, we're not the bank, yeah.
Cool, thanks.
All right, we still have a time for one or two short questions.
Yeah, so thanks for the talk. Quick question, because you mentioned a little bit, right? The project has to be somewhat late in the stage to be able to do it, right? Should have some revenue, etc. What kind of levels are you looking for in terms of revenue and its relationship to the loan size? Are there like any metrics that you defined?
Yeah. So again, we're a marketplace, so we don't necessarily define those. It's up to the lenders if they're comfortable. The main thing would just be history and consistency. So if you just have 1 month of whatever, $1 million of revenue, but you didn't make any money before that, and we don't know if you're gonna make that amount again afterwards, that's obviously a consideration. Versus if you have like a very small amount of revenue, but it's consistent over many months, that obviously changes the equation. And then because people can offer you terms, multiple lenders can offer you different amounts at different interest rates. So someone might say that you want to borrow for like 90 days, let's say, and someone would say, okay, I'll lend you $100,000, but it's going to be 20% interest. And then someone else might say, I'll only lend you $10,000, let's say, but it'll be at 5% interest. And then you as the borrower get to decide which one you want to take. So it could be a larger amount with higher interest or a lower amount with lower interest.
Got it. So it's still up to the lender basically to decide, right? Because I can come onto the platform saying, okay, I earn like $1 every month.
Yeah.
And then maybe there is someone who is willing to give me $1 million, right?
Yeah.
Okay.
Thanks so much. This is all the time we had questions in this session, so thank you, Kiba, once more.
Thank you.